In this video, I'm going to be talking about what's going to happen to mortgage rates in the future and by association, savings rates, because I'm going to be focusing on the Bank of England base rate. The Bank of England base rate influences both of these things, in particular mortgage rates, which is what I'm focusing on today. Now, if you find this video useful, make sure you hit that like button, but also subscribe to the channel. I update these videos regularly, so make sure you don't miss out. Now, I'm going to focus on the market predictions of where the base rate goes. And the way that they do this is that we look at the numbers of overnight swap rates. Don't worry about what they are. You don't need to understand. But what I'm going to do is show you a chart on screen that gives you an indication of the market's predictions and how they've changed over time about where the base rate is. As I make this video, the base rate is currently at 5%. The Bank of England decided to keep the base rate at 5% at its September meeting, following a cut in August from 5.25% to 5%. Now, the market, if you look at the chart on screen, is showing that the prediction is for the base rate to fall faster and sooner than previously thought in August. So each of the lines you can see on screen represent predictions made by the market at different stages. So the blue one is July 2023, so more than a year ago. If you look at the purple one, that was a prediction in August, and the red one is the one that was made in the mid part of September. So September 2024, you can see that red line has steepened. We've got a quicker descent. Go back to July 2023, the market was thinking the base rate would be at this point in time above 6%. Obviously, things have changed. The Bank of England raised its base rate to control inflation, something that it seems to have succeeded in doing. Now the market is predicting that the base rate will fall quicker than previously anticipated. The purple line, as I said, was the prediction in August. What it means is that in reality, the market thinks the base rate will get to below 4% at some point in 2025. So by the start of 2025, it's going to be predicted to be around about 4.4%. By January 2026, around about 3.3%. And then it's gradually going to fall to 3.14% in January 2029. So you can see from that chart that the long-term average, the predictions that we're going to be just above 3%. That's going to influence fixed rate mortgages. We're going to start probably heading towards that level. So what that means is that the long-term fixes in mortgages are going to start to come down. And we've already seen that. For savers, of course, we've probably seen the peak of savings rates. If you want to get the best rate of return, you need to start shopping around now. On screen now, you can see an article on the Money to the Masses website. I'll put a link to it in the notes. You can look at it at your own leisure. We do update it twice a week, so it is updated very regularly. Make sure you bookmark it. If I jump straight down, we are now at the point where you can get a 2-year fixed rate mortgage for 60% loan to value at below 4%. That is significant. It's from Santander, but do be mindful of the lender fee. That is something you've got to bear in mind when you're looking at and comparing any of these mortgages. The one thing I would say, that particular Santander mortgage is for people who are purchasing. Remortgages, you are at the moment paying above 4%, still around about 4.2%. So they are coming down. We're going to probably see more of those in the near future, especially if the Bank of England cuts the base rate in November, as the market is predicting. Looking at 5-year fixes, we're looking at something like 3.77% as the best for the 60% loan to values, going all the way up to 4.54% for the 90% loan to values. Where we've seen the biggest cuts actually in recent weeks in mortgage rates has been those higher loan to values. 10-year fixes are on screen. You can pause and look at it at your own leisure, but I don't think many people are really that engaged with the 10-year market. When regards to tracker rates, they've also come down. We can get 4.59% on a 60% loan to value for a 2-year tracker. That was at 4.99% a few weeks ago. That was the best rate. So we're already seeing that come down in response to the market's predictions of where the base rate is going to be. Right now, I think the difference between 2-year fixed, 2-year trackers, and even 5-year fixes are starting to narrow. So the conversation is going to be more around whether you fix or take a tracker. I think there'll be people who will still seek the comfort of fixed rates because they may have, for example, be coming off a very high fixed rate that they took out in the aftermath of that infamous Liz Truss mini budget. So there are the rates on screen. 5-year trackers are still pretty punchy at 5.6%, but there are significant changes that are happening. And so do bookmark this particular article and subscribe to our channel, because there are going to be those significant changes going forward if the market's predictions come to fruition. So if you found this video useful, like I say, hit that subscribe button. Do hit the like on this video, but also ask any questions because I will do my best to answer them.